Hi everyone, I'm Paula, and on this channel I break down what's actually moving the crypto markets without hype, without fear, and without chasing every headline. And today I want to talk about something I know a lot of you are feeling, because I feel it too when I scroll through crypto news. Every headline feels like it's arguing with the last one. One story says Bitcoin is heading for six figures again. The next says the bear market has already started. Another says volatility is about to explode. Then another says nothing is happening at all. And if you're sitting here thinking, how can all of these be true at the same time? You're not behind. You're actually seeing the market clearly. Because what we're in right now isn't confusion, it's transition. And today I want to slow this right down, pull these stories together and explain why the market sounds so conflicted, what's actually happening underneath the surface, and what matters far more than any single prediction. Over the last couple of days, we've seen major institutions talking about Bitcoin reaching well into six figures over the next year or so, if conditions line up. At the same time, on-chain analysts are warning that demand has slowed, momentum has cooled, and downside risk exists in the near term. Then you've got other outlooks suggesting a pullback could come before better opportunities later. And when you put all of that together, it feels overwhelming. But here's the key thing. These stories aren't actually contradicting each other. They're talking about different clocks. When institutions talk about six-figure Bitcoin, they're not saying that's happening tomorrow. They're outlining a scenario. If regulation improves, if institutional demand continues, if macro conditions eventually turn supportive. That's not a prediction. It's a conditional outlook. On the other side, on-chain data is focused on what's happening right now, flows, momentum, behavior in the current phase of the cycle. And those two perspectives can exist at the same time. In fact, they often do. Some of the strongest long-term setups begin during periods of short-term frustration. So instead of asking which headline is right, the better question is, what phase is the market actually in? Right now, the best way to describe this market is compressed and undecided. Volatility has tightened across Bitcoin and Ethereum. Ranges have narrowed, moves start then fade, breakouts don't follow through. This is not random. Compressed volatility usually means the market is waiting for liquidity, waiting for clarity, waiting for positioning to resolve. Until that happens, price gets pinned. Derivatives are a big part of this. There's been a large build-up in options exposure around key levels. And when that happens, price behavior can look unnatural. Instead of trending, price oscillates. Rallies get sold into, dips get bought just enough to prevent collapse. Everyone feels like something should be happening, but it isn't. That's not manipulation, that's structure. And it's one of the reasons headlines feel disconnected from price action. Now let's bring macro into this, because a lot of people expected clarity here and didn't get it. Yes, US CPI did come in lower than expected. Inflation easing is a positive development, and it supports the idea that the worst inflation pressures are behind us. But one softer print doesn't suddenly flip the macro environment into full risk-on mode. Inflation is still above target, and policymakers have been clear they want consistency, not just one good data point. So while CPI cooling helps, it doesn't give the markets the green light they're waiting for, which is why price action has stayed cautious rather than explosive. Another important piece is real interest rates. Even with inflation easing, real yields remain relatively high. Cash and short-term treasuries are still attractive, and as long as that's the case, capital isn't forced to rotate aggressively into risk assets like crypto. That's another reason good inflation data hasn't immediately translated into upside. At the same time, central bank messaging has stayed firm. There's no urgency to cut, and markets care far more about action than hope. Then there's the US dollar. Crypto tends to perform best when the dollar weakens meaningfully. Right now, the dollar isn't surging, but it hasn't broken down either. That creates a neutral backdrop, not a tailwind. Without sustained dollar weakness, crypto remains dependent on internal structure rather than macro momentum. Globally, policy is also pulling in different directions. Japan is tightening, the US remains restrictive, other regions are mixed. This lack of synchronized easing matters because sustained crypto rallies usually happen when global liquidity expands together, and that's not what we have right now. So again, this isn't bearish, but it isn't decisive either. Add in year-end effects, thinner liquidity, more caution, less conviction, and it becomes even clearer why price feels stuck. That alone can keep markets range-bound, even when longer-term narratives remain intact. Now let's talk about EFTs, because this is another area where headlines confuse more than they clarify. We've seen strong spot Bitcoin ETF inflows recently, which sounds extremely bullish. But ETF inflows don't automatically mean immediate price expansion. Sometimes they represent long-term positioning, sometimes they offset selling elsewhere, and sometimes they get absorbed quietly when liquidity conditions aren't ready yet. What's also important is where these flows are going. Bitcoin dominance has been rising, while Ethereum and altcoins continue to lag. This tells us this is a flight to quality, not a broad on-risk environment. Constructive long-term, but not a guarantee of short-term fireworks. This is where the tension comes from. Long-term bullish narratives still exist. Institutional interest hasn't disappeared. Infrastructure hasn't gone away. But short-term momentum has cooled. Volatility is compressed. Liquidity is thin. And macro hasn't flipped. So neither side gets confirmation. And when the market won't decide, people decide for it, which is why headlines sound extreme in both directions. Trying to trade predictions in this environment is dangerous. Price targets without timeframes are meaningless. Long-term upside doesn't invalidate short-term risk. Short-term caution doesn't invalidate long-term opportunity. The mistake is assuming that only one can be true. What actually matters right now is liquidity, volatility expansion, and positioning resolution. Compression never lasts forever. When volatility breaks, direction flows. Until then, patience matters more than conviction. And I want to say something important if you're feeling uneasy watching this market. Uncertainty does not mean danger. Some of the worst decisions happen when people mistake uncertainty for urgency. Right now, the market isn't screaming at you to act. It's asking for you to observe. Historically, the periods where news feels most contradictory are often the periods right before clarity emerges. Not because headlines improve, but because structure resolves. And once structure resolves, narratives follow, not the other way round. So if you're feeling unsure, that doesn't mean you're doing something wrong. It means you're paying attention. The biggest mistake right now is forcing conviction when the market hasn't earned it yet. You're not missing anything. You're watching the market breathe. If this helped bring clarity to the noise, give the video a like. It really helps the channel. And if you want more breakdowns like this, make sure you're subscribed. And as always, if you want to understand the exact strategies that we use to make money in both the bull market and the bear market, the link to the free crypto liftoff course is in the description. Thank you so much for watching, and I'll see you on the next one.